You know how it is. You see a financial report from a company, in this case, construction firm Abundante Limited, and the headline number looks incredible. But we all know that's just the tip of the iceberg. So today, we're going to dig into their latest financials and find out what's really going on. Is this a sign of some amazing, sustainable growth, or is there maybe some trouble on the horizon? Let's get into it. Okay, so here's the number that's got everybody talking. A 216% jump in profit in just 6 months. Now, a surge like that is pretty wild. It really makes you stop and wonder, right? Is this just some kind of one-time fluke? Or have they actually figured out a secret sauce for making money in their industry? But, as any smart observer knows, one huge number, no matter how impressive it looks, almost never tells you the whole story. So our job here is to unpack that 216%. What's actually driving it? And, probably the most important question, can they keep it up? To figure that out, let's start by doing a little anatomy of this profit surge. Where did all this extra money actually come from? We've got to peel back the layers here, starting from the top and working our way down. And here are the raw numbers. Their net profit shot up from about 103,000 Singapore dollars to 325,000. So yeah, the percentage is massive, but it's also a pretty significant leap in real dollars, going from a decent profit to a much, much healthier one for a company this size. So first things first, where did that profit boost come from? Let's look at the top line, revenue. That's the total cash coming in the door. It grew by a very healthy 16%, from around $3.5 million to just over $4 million. That's good. That's solid growth. But a 16% bump in sales doesn't get you a 216% explosion in profit. The real story, well, it's hiding in the margins. And boom, here it is, the gross profit. This metric is absolutely key. It's the money left over after you pay for the direct costs of getting the work done. Labor, materials, all that stuff. It's really the purest measure of how profitable their core business is. And as you can see, it more than doubled, jumping 101%. This tells us everything. Abundant didn't just sell more. They made way more profit on everything they sold. They figured out how to be dramatically more efficient. So we've zeroed in on this massive leap in profitability, which, of course, leads us to the next big question. How'd they do it? What were the secret ingredients behind this incredible performance? Well, the company points to two main things. First, an improved project mix. Basically, that means they got smarter about the jobs they took on, probably shifting away from low-margin work to more lucrative contracts. And second, stronger pricing. Put simply, they were able to charge their clients more, which suggests people really wanted their services. These two things were so powerful that they totally blew past some minor negatives, like making less money from interest and not having a one-off asset sale like they did last year. So it's a fantastic story, right? Better efficiency, better pricing. It's a textbook case of working smarter. But this is where the whole story takes a pretty sharp turn. Because the company's own statement about the future is basically ringing some very loud alarm bells. And here's the warning, straight from them. They expect to face challenging price erosion from competitors. Let's just translate that, okay? They're getting ready for a price war. The very thing that made them so successful recently, charging higher prices, is now under direct threat. Their rivals have seen those fat profit margins and are probably coming to undercut them. A looming price war is a serious, serious threat. It can just destroy profits. So, what's the game plan? How is Abundant planning to deal with this, to protect the profitability they just worked so hard to build? Their response is a classic three-part strategy. First, remain vigilant, which means watch every single penny and every move the competition makes. Second, refleet equipment, which just means they're going to invest in newer, better machines that can do the job faster or cheaper. And that ties right into the third point, improve operational efficiency. The logic here is crystal clear. If you can't raise your prices anymore, you have to win by lowering your own costs. It's a defensive strategy, but a necessary one. Of course, having a plan is great, but you need the resources to actually do it. And this right here, this is Abundante's trump card. I mean, look at this. They are in an incredibly strong financial spot. Zero bank debt, almost $1.8 million in cash, and nearly $10 million in other financial assets. This gives them a massive war chest to invest in those new machines and to survive a price war without having to worry about bankers breathing down their necks. That is a huge, huge advantage. And so this is where it all comes together. Abundante has just had a phenomenal 6 months. They were smart, they had pricing power, they have the financial muscle, and a clear plan to defend themselves by getting even more efficient. But they are sailing straight into a competitive storm. So the critical question becomes, is that efficiency plan going to be enough? Will it be a strong enough shield to protect those profits they just fought so hard to win? For Abundante, the real test is just beginning.